Prime office rents in Asia Pacific are finally on the rise, up 0.2% in the second quarter, marking the first increase in nearly 3 years. Joining us to discuss this are Kristen Lee from Knight Frank and Mike Davis from Colliers. Now, jumping right into our topic, after nearly 3 years of decline or stagnation, what's driving the recent uptick in prime office rents across Asia Pacific?
Basically, I think the driving forces behind the rental rates are first, flight to quality. It continues to shape occupier behavior because some of the demand basically is concentrated in the newer and the ESG compliant and also well-located assets. And after a prolonged period of stagnation, I would say limited supply in the CBD stock in a lot of the core office spaces, basically supporting this rental resilience. And also in many markets, I think tenants are also taking advantage of the soft rental market and also the incentives to upgrade their space requirement to newer and better grade buildings.
Many markets have been slowly trending up this whole time, and we are seeing continued momentum from the second half of 2024. The universal factor across all these markets, though, is flight to quality. Occupiers are increasingly prioritizing grade A properties that reflect their brand, meet their corporate ESG goals, and have amenities that will improve their employees' experience. Demand is up nearly 10% year over year across the largest markets in the region. And if you couple that with limited new supply in markets like Singapore and Seoul, that has created a shortage of quality space that is driving rents up.
Which brings me to the question, why did it even take nearly 3 years for rents to rebound?
While a number of markets are performing quite well, there are markets like mainland China and Hong Kong that have been managing an oversupply of office space that has pushed rents down and vacancy up quite considerably compared to the 2019 peak. And post-COVID, it did take companies some time to sort through their return to work or hybrid work policies and ultimately implement them. And finally, if you add in other factors like inflation, interest rate volatility, and now global geopolitical concerns, companies have been a bit cautious about taking new space and spending CapEx dollars.
I think the slow rebound really basically reflected a delayed decision making, particularly during the post-pandemic recovery, because a lot of occupiers are not sure what hybrid working model is like. So some of the occupiers, they decide to take less space than expected. And later on, when they right-size their portfolio, they realize maybe they have to take a little bit more or a little bit less. So that overall experiment lasted us for almost 3 years. And during the pandemic, of course, we have seen office vacancies at high, especially in many North Asian markets like the mainland China, as well as Hong Kong. Certain other markets have also faced with muted demand because of the geopolitical issues. So we do see a lot of disruptions into the office space, particularly, with these tech disruptions, return to office. But having said that, I think Asia Pacific is still positioned very well for the office recovery story because our utilization rate is one of the highest around the world.
And based on your observation so far, which specific markets led the growth?
I think the markets in Australia have been poised for recovery. So the leading market was actually Brisbane. It rose almost 12% year on year, and followed by Sydney, as well as Melbourne, Adelaide. They were all basically under recovery mode. And apart from Australia, we also saw some demand coming in from India. This is actually a very encouraging sign because of the China Plus One strategy. Although there's a bit of a hiccup because of the recent tariff rates between US and India again, but we are very convinced that India is going to continue to drive the office demand for Asia Pacific region, particularly from the Global Capability Center as well as the flex operators.
From an industry standpoint, it's tech and banking and finance companies that are driving a lot of the growth across these markets. From an absorption standpoint, the largest growth occurred in markets like Singapore, where demand was up 12x year over year, which was driven by a flight to quality. Now, to be fair, that number is a little bit misleading because the numbers in early 2024 were quite flat at about 40,000 square feet of absorption, whereas it was closer to 500,000 square feet this year. Tokyo saw 55% year-over-year growth despite a nearly 2% vacancy rate. And the Philippines saw 56% growth fueled by the outsourcing business. And finally, India continues to be the most active leasing market in the region, with over 30 million square feet of absorption, representing a 13% year-over-year growth.
Before we wrap up, let's give our viewers some forecast. How is this recovery expected to continue in the next quarters?
I would say the recovery will continue, but it's going to be quite gradual and uneven. Firstly, I think the office market is still facing a lot of challenges, although, with more technology, with more data coming in, occupiers will have a better knowledge of what is the utilization within the office space, and that's going to point towards a more rational taking up of the office space. And secondly, it's going to be bifurcated because the best grade offices will still be in short demand, but when you come to the less desired office space, it's going to face a lot of structural vacancies, and that's going to be challenges and pressures on the recovery. And thirdly, I think the overall environment is that we are seeing this rationalization of the space usage, because real estate is still the second largest cost for any occupiers in today's world. And with all these ongoing geopolitics, it's going to be quite uncertain and volatile, and businesses want to stay nimble and not overcommit to such a big expense. So we think that it's going to be a steady, gradual recovery for the office space, but it's not going to be growing like what we have seen in the last 10 years before pandemic.
Demand is expected to continue to strengthen across most Asia-Pacific markets in the second half of the year. Singapore and Seoul will continue to see rent growth due to tight supply. Seoul does have some new supply coming, but on the other side, Tokyo will have limited new supply in the next few quarters, which will put more pressure on vacancy rates and continue to drive rents up there. Mainland China and Hong Kong may face continued rent declines as new supply continues to be delivered. But overall, occupier preferences for green certified buildings, flexible spaces with access to building and nearby amenities for their employees will continue to shape leasing decisions and drive investment strategies.
Thank you so much for sharing your insights and for joining us today, Christine and Mike.
Thank you for having me.
Thank you for having me again.
Once again, those were Christine Lee, Head of Research Asia Pacific at Knight Frank, and Mike Davis, Managing Director for Occupier Services Asia Pacific at Colliers. For more news, visit realestateasia.com.